In the last several videos, we introduced the balance sheet and talked about the important connections between the balance sheet and the income statement. And specifically, we talked about the nexus being in the retained earnings line. Well, now let's take a step back and really dive into the most common balance sheet line items. We've really been talking about them in bird's eye views so that we can talk about the more important connections. But now I'd like to go through each common line item and make sure that we understand what moves that line item up, what moves that line item down, so we can get a better understanding of how the accounting process works. So the first thing to remind everyone is that assets are presented in descending order of liquidity. Cash is the most liquid asset, so it's always going to be first. Cash is usually followed by assets like accounts receivable and inventory, as these can be converted into cash fairly quickly or sold fairly quickly. Less liquid assets like property, plant, and equipment, and intangible assets are listed towards the bottom of the asset side of the balance sheet, and that's because they are less liquid. Now, as long as assets can be converted into cash within 12 months, they're considered current. There's a term for it. And in fact, current assets are classified as such on the balance sheet. Here we see Walmart's balance sheet, and we see that Walmart identifies their current assets as cash, receivables, inventory, prepaid expenses, and current assets of discontinued operations. We're going to get into just about every one of these line items, but the main takeaway is that these current assets represent assets that can be converted into cash within 12 months. Or at least the company expects to be able to convert them into 12 months. It doesn't by any means mean that the company has to convert them. It just means that they are liquid enough whereby the company's expectation they will be converted into cash within 12 months, or can be. Now, property and equipment is never a current asset. It represents equipment and property and land and things that have a useful life of more than 1 year. And notice that it's presented as the aggregate of two lines: property and equipment on a gross basis, less accumulated depreciation. And what's actually presented in terms of counting the asset is the net impact of that. And that's going to matter for us when we get to the property, plant, equipment section. You also see that they have property under capital leases, goodwill, as well as other assets and deferred charges. We're going to get to all of those throughout the course of this discussion. Liabilities are presented in order of when they are to be paid. So if assets are presented in the order of how quickly they can be converted into cash, how liquid they are, liabilities are the inverse of that. Things like short-term debt, accounts payable. These are things that are represented as current liabilities, and they are to be paid within 12 months. Long-term liabilities, on the other hand, these are things like long-term debt. They're not due within the year, and they're represented below current liabilities. And we see for Walmart that you have this representation of things that we've already talked about, like accounts payable and short-term debt, that's represented as current. And then you have long-term debt as the biggest line item of non-current or long-term liabilities. At this point, let's go through an exercise. I'd like you to label each item as either a current asset, a non-current asset, a current liability, or a long-term liability. So hit the pause button, give it a shot, and when you're ready, hit unpause and we'll go through it as a group. Cash is a current asset. Money owed to suppliers within 30 days is going to be a current liability. That's an accounts payable. A 6-month bank loan is short-term debt. That's going to be a current liability. A warehouse is going to be a fixed asset, so that's a non-current asset. Inventories waiting to be sold are going to be current assets. And a 5-year bank loan due this year is going to be a long-term liability. Marketing employee salaries was actually a trick question. None of the above. It is not a balance sheet item. Employee salaries are expensed immediately. A corporate jet is a fixed asset, and that's going to be a non-current asset.